conflict involving Israel and Hamas in Gaza has been raising questions about the stability of the energy sector, especially amid fears of a broader Middle East violence. Hussein Allidina is head of commodities at TD Asset Management, joins us now for some perspective. Hussein, obviously it's been a pretty startling chain of events over the last several days, and the oil market reaction has been curious as well.
It has been, for sure. I guess very depressing situation that we're seeing in the Mideast. I think from a oil perspective, we saw the market rally on the open on Sunday, on the heels of the attacks on Saturday. The market has retreated a little bit of late. I think from a supply-demand point of view, clearly there isn't production at risk in Israel or Palestine. You do have potential for this situation to escalate if Iran gets involved. Iran is producing and exporting more oil than they have in the last 5 years, north of 3 million barrels a day. So there is some risk there. Hopefully that is a sort of tail event, a worst case scenario, but I think given the tightness in inventory, given kind of how fragile the balance is right now, it likely makes sense to embed a bit of risk premium around that.
Is that sort of what the market's trying to figure out right now? And obviously these are early days, but the events are moving quickly as well, that you can't really just come to a thesis at this moment and say, this has happened, so this will happen, so this will happen. Very fluid.
It's extremely hard. I think when we go back and look at prior events, so a few years ago we had the drones that attacked the refinery in Saudi. You saw the market trade up pretty meaningfully. Typically these supply disruptions are, when they occur, are not long lasting, so you see that premium come out. But there have been instances, which I'm sure are fresh in the minds of some, where you've seen material reductions in production. So 50 years ago the Arab oil embargo contributed to sending oil prices from $3 a barrel to $15 a barrel. So there is some of that risk in mind. When you look at balances and you look at sort of the production that is at risk right now, it is very minimal. I do think that the events that have unfolded over the weekend temper the likelihood of a rapprochement between Israel and Saudi, which was something that the bears had been talking about as we look to year-end and into 2024. I mentioned Iranian barrels. Iranian production has been a source of supply to the market, and there's potential for those sanctions to be sort of, the sanctions never disappeared, but I think the U.S. kind of turned a bit of an eye, and you might see some of those volumes come off, which the oil balance really can't afford.
Yeah, we're showing the audience right now a chart that you brought along about oil production in Iran, and clearly, I mean, from the timeline here, there definitely has been a ramp up.
There's been a material ramp up, and that's part of the reason that the draws that we have seen have not been more pronounced. I think that if that production is at risk, which I think the market, as you mentioned, is trying to figure out, it paints a very constructive picture. But again, supply-induced shortages are not great for growth, are not great for inflation. Very different than sort of prices going higher because of a demand surprise.
Now, we have seen a situation too, and you mentioned Saudi Arabia, the fact that they have been constraining production to meet their aims and goals. If you ended up in a situation where, say, Iranian barrels are taken off the market, you think you have a tighter market, what would Saudi Arabia perhaps do about that?
So I think the good thing about where we are today is that Saudi Arabia, Kuwait, UAE, some of the Gulf countries have reduced production intentionally, so their spare capacity, OPEC spare capacity, is probably north of the 3 million barrels a day that Iran is producing right now. So ultimately, if there was a disruption, I think that you could see an increase in production from Saudi and some of the other Gulf countries to alleviate that disruption. Ultimately, though, as spare capacity falls, the market worries, because if there is another disruption, then there's no sort of buffer to meet that. But absolutely, if you lose Iranian production, Saudi could increase their production to mitigate that loss, I think.
Also, if we were having this discussion only a couple of weeks ago, or maybe only last week, we would be talking about the broader global economy. You get different global agencies pulling back their growth forecasts, saying words like tepid. Usually that plays into the oil trade. Does that get further complicated into this mix about worrying about demand if this recession that I think you and I have been talking about, and all the other people we've had on the show have been talking about for a year and a half, actually shows up?
Yeah, and I think, look, if oil prices are moving higher because of supply-related concerns, that is not great for growth. I think the thing that we have to keep in mind from a commodity perspective, oil demand is expected to decline next year, the demand growth. The absolute level of demand, though, on most forecasts is still above supply, and that still, on a full year basis, portends to inventory draws. So again, in equity land and fixed income, we talk a lot about the second derivative, the rate of growth. That is important for commodities, but if oil demand slows, but not enough to kind of fall below supply, then I'm still drawing inventories, and that's still a constructive backdrop.
Now, we may actually talk about this a bit later on, but I wanted to squeeze this in right now because apart from everything and very important things that we've tackled so far in this conversation, we actually have some M&A activity.
Yeah, we do.
In the oil and gas sector. I wanted to get this one on Exxon. This is their biggest purchase, I guess, since they became ExxonMobil.
It's interesting. So Exxon is definitely growing their reserve base, growing their production profile, but they're doing so by acquiring Pioneer. That's great for Exxon, potentially great for Exxon shareholders, but does not change the oil balance, right? Exxon could have said, look, we're going to go look for incremental upstream production in the Permian or offshore Guyana, wherever. Instead, they've decided to buy Pioneer. There might be some implication as to, well, it's easier to buy a company than it is to grow production in this environment. And I think that's telling.
Let's get into that. That is telling in the sense that we've seen all these oil and gas majors returning money to shareholders, and now they're making acquisitions. But as you said, an acquisition that doesn't actually grow global production numbers. Yeah,
and look, at the end of the day, we've talked about this before, we have to be able, if we believe in GDP growth, that GDP growth still requires oil demand. That's, that dialogue, that narrative has been broken. People think that oil demand is peaking. Oil demand reached record highs in July and August of this year, notwithstanding the fact that the economy hasn't been as robust as we thought, notwithstanding the fact that China hasn't been firing on all cylinders. If you believe in GDP growth, then implicitly you believe in oil demand growth. In order to meet that oil demand growth, we need to be investing in the supply side. If we don't, then prices have to ration demand to find equilibrium.